Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. Welcome to our YouTube channel. If you like this video, please give us a thumbs up. You can always hit the subscribe button as well if you want to be alerted for future videos. So it's been a busy week, and I put out some extra commentaries last weekend as far as the mean reversion bounce setup that was in play. And man, it came and it went just as fast. Last weekend, I had 3 articles focusing on the possibility for a mean reversion bounce, and then we got it. And I put out an article called Whack-a-Mole. It should have been called Whack-a-Bull because what happened here is you can see, as I showed in the commentary later on, that we'll see that SPY had entered its first retracement zone here. It had retraced 50% of this prior decline, and that was the first danger zone. You know, I had no idea it was going to fall this fast as it did, and I didn't know if it was going to peak above the 61.8% retracement, but I just knew that if you're in a bear market environment and you retrace 50% of a prior decline, that puts the advance in a danger zone because the bigger downtrend is the dominant force at work. Also, we had the broad market timing model, and this is from this past Friday. And just a little thing here, look at this wedge in IWM. This is a lower high, this is a wedge break, and that projects a move below that December 2018 low. So very negative for IWM. And then something else I introduced in this commentary, I put out some correlation tables for these sectors. And we were looking at 20 and 65-day correlation. And the green is the positive correlation, strong positive correlation. The red is not negative correlation, it's just less positive. So you can see utilities and REITs have a less strong correlation with the other sectors, but it is still quite strong. It's above 0.80, the 20-day correlation coefficient. And of course, every Thursday, I have the ETF ranking, grouping, and analysis report. And in this Thursday's report, I noted that even though we had the bounce, you can see who led the bounce on Monday, Tuesday, and Wednesday. Staples, utilities, real estate, and healthcare. You had the defensive sectors leading the bounce, and the offensive sectors getting strong bounces, yes, but lagging, showing relative weakness, and that was not a good sign. And then I went ahead and singled out some ETFs and put the strong ones at the top, like TLT and gold, and the weak ones at the bottom, like IJR and XLE, the energy SPDR. So that's kind of a brief review of what was going on at Trend Investor Pro. And you can always click on the subscribe link to see what we have to offer. I think it's a very reasonable price for what you get. And there's also a video where you can get a tour of the website and what we are doing. So this weekend, we're talking about dubious retracements and questionable supports and what makes them dubious and questionable. Because you can definitely, get on a chart and you can mark support levels based on the August low and that early October low, or on this March low and May low and mark support. And then you can draw a Fibonacci retracement from the December 2018 low to the February high. And there you can see a 38.2% retracement there. Or you could draw one from the May low, or that's the early June low, to that February high, and you see a 61.8% retracement. But, at some point, you think, or you have to assume, based on the broad market environment, that the odds of support holding and the odds of a Fibonacci, a bullish Fibonacci retracement zone resulting in a reversal are reduced. And that's what I think has happened now. We basically had a gap down here. We've had a gut-wrenching decline below the 200-day. The mid-cap index and the small-cap index IWM, the ETFs actually, MDY and IWM, hit 52-week lows intraday on Friday. I'm recording this on Friday morning, by the way, but it's still valid. But the point I'm making here is we've shifted from a bull market environment to a bear market environment. And this is based on the breadth models that I use at trendinvestorpro.com. And when you shift from bull market to bear market, you're playing under a different set of rules. In a bull market, support is important and expected to hold. Bullish retracement zones are places to look for reversals. But in a bear market, that is not true because the path of least resistance is down in a bear market. And so that means support levels are not expected to hold. Fibonacci retracement zones are not expected to give way to reversals. So you can say, well, this one did. Well, I mean, come on, we got all the way down here to 285 before we actually reversed. There's a lot of volatility in here. But my point is, we got to learn what to ignore on the chart as much as what to focus on the chart. And I think the environment has shifted from bullish to bearish. So I'm going to ignore support levels and I'm going to ignore bullish retracement zones. So what am I going to focus on? Let's look at that. So in a bearish market or in a bear market environment, resistance zones become important and bearish retracement zones become important because those are the spots where you can expect a reversal. Now, nothing is 100%. I'm just talking about the odds here. But what I'm talking about is in a bull market, the odds of support holding and a bullish reversal in a retracement zone are higher than they are in a bear market. In a bear market, the odds of support holding or a bullish reversal are reduced. Instead, the odds of a bearish resolution in a resistance zone or a bearish resolution in a bearish retracement zone are increased. And that's what we had happen this week. If you look at this decline, it is humongous. It is 2 steps down, basically, 2 steps backward, and then we got 1 step forward. So a 50% retracement is normal for a counter trend bounce. So you can see we came down hard, we bounced, and we hit that zone there. That's the 50 to 62% retracement zone. So that's the danger zone. And now we've declined. And with this decline, we now have the first resistance zone to watch. So resistance is important in a bear market because if it's broken, then you have to reassess. So if we can get above 315, then we have to reassess. But right now, that first retracement zone has worked in offering resistance and bringing in a sharp reversal to the downside, even if it is just short term. But from this point forward, I'm not going to look at those support levels or bullish Fibonacci retracements levels. I'm not going to look for the next support zone. I'm going to totally ignore it. I'm going to look for the next resistance zone and the next bearish Fibonacci retracement zone until the bear market turns into a bull market. And how long that will be, I do not know. So that concludes this video for trendinvestorpro.com. Remember, if you like this video, please give us a thumbs up or consider subscribing. And you can always visit our website, trendinvestorpro.com, for more information. Thanks very much for tuning in and have a great day.